Welcome to today's edition of The Real Estate Guys, featuring moi, Alan Jacobson from Florida, and my friends Trip Dunham from Kansas City and Sean Johnston from Billings, Montana. Today, we're going to talk about something that I think some of you would really like to do, but may not know a lot about, and that's investing. And what we want to discuss is questions that you, as a potential investor, should be asking. Or if you don't know what questions to ask, we're going to help kind of force feed you a little bit of information so you know what to look for when you're looking to invest in property. And this is whether you're a first time investor or even if you're a little more seasoned, but maybe you could glean something from what we're talking about. So I opened it. I'm going to ask my friends here who wants to come up with like the first question that comes to your mind.
Well,
I
I'll
will.
jump
Go
in.
ahead, Sean.
Drip, you want to go ahead? Go ahead.
I was just thinking that, if you're looking to um, engage in investing, first off, I think you have to define what types of properties in real estate that you're interested in. Is it single family residences? Are um, are is the agent familiar with multifamily, um, self-storage, or any other asset class, or is it commercial buildings? Um, so I think that's the first thing, is kind of defining uh, what an agent specializes in and how they can help you with that process. And you have to know what you want as if you're looking to invest in properties. Also, I think that it's important to know, given that whatever that specialty may be, is how do you find your inventory? Uh, that would be a great question for an agent. Like, how do they come up with properties? And as an example, single family homes, you know, most investors out there are looking for off market properties. So they're looking for properties that haven't, not that they don't address properties that are on the multiple listing service, but they prefer to get them before the world sees them. So the question that you would ask your agent is, what's your methodology to get properties before they hit the multiple listing service? And I think that's worthy of digging into, because those often are the most profitable for the investor, simply because there's not such competition for the off-market process. So to summarize, what's the process that you have in place to find those?
Well, I think it's also important, very important, to start out with knowing what the person's budget to spend is, because that's going to help determine partly what types of properties they can invest in. So let's say hypothetically somebody says, well, my budget is $500,000. Well, $500,000, what can you get for that? Is it going to be a single family home? Can you get a duplex? Um, I would say something like an apartment building or a storage unit. Um, Probably not going to be able to afford that. So it's really important to look at that and to know if they're going to pay cash or finance, because that's also important. Because if they're financing, then it will depend on what they can qualify for. So if they don't know the question to ask, I would ask them right away, well, what's your budget and what are your goals? What is it you're looking to achieve in investing? Are you looking for investing to flip a property, or are you looking for a hold property that you can get an annual return on your investment? So that's kind of where I would start. What do you think, Sean?
I think you're both right on the absolutely on the right track. I've chuckled over the years and told people the only mistake I ever made in real estate was selling. Uh, but when I started investing in real estate 25 years ago, I bought to flip. So I would look for either dirt that I felt was going to go up in value or that I could afford. And I didn't have a lot of money back then. So I was buying stuff that I could get on contract for deed and carry a small, carry a 30-year note with a 2-year balloon, hoping that I could flip it and sell it by the end of the note.
So I'm
Uh,
sorry, I'm sorry to interrupt. Could you explain to our audience what contract for deed means?
Yeah, most definitely. It's basically where the seller becomes the bank. They they carry the financing for the buyer, and so you give the seller of the property a down payment. Usually, well, you always try to make it as small as you can possibly get away with, obviously. And then uh, probably the most common scenario that not only have I personally purchased, but I've probably written 5 of them just in the last few months here locally, is where you would amortize the purchase price over a 30-year amortization. So like a 30-year mortgage for the payment
Right.
to calculate the payment. But then you would have a balloon payment due in some window of time, usually 12 to 24 months. During that time frame, you can fix the property up. You can, oftentimes I have a couple clients who love to just shop for dirt. And when they find what they think is a good price or a good property, they'll buy that. They'll sit on it for a year and then put it back on the market, make $5,000 or $10,000. So I started in that realm personally, and then transitioned into flipping houses where I thought I was going to make lots and lots of money. And I did make a fair amount of money doing it, but that becomes a different environment as well, because if you buy and flip quickly, you don't hold the property for 24 months, you end up paying income tax on your proceeds instead of a capital gain, and that has a different impact. Uh, and looking back, if I held on to all the houses I flipped back in the day, I'd be a multi-millionaire today. And I would have a substantial amount of cash flow being, paid out from those properties. And so what you guys were saying about, especially what you were just saying, Alan, about what are your goals? I didn't have a very well-defined goal when I started. My goal was I want to buy and sell real estate and I want to make some money, not what's the long-term outcome that I'm trying to accomplish. And so those are going to, for most people, I think once they understand that, and those are difficult conversations for most of us to have to really define what we want. Uh, but once you've done that, then it really will help them dial in what they need to look at. So I think those are great. Then you need to find somebody that when I started, I went and looked for people to interact with or to have as representation who themselves had flipped homes. So they understood the risks I was taking. They understood the financial impacts of what I was doing, and could help evaluate things from experience rather than from theory, which I think is probably the biggest danger in real estate in general, is working with somebody who may not have the background or experience in the particular realm that you need help in. And so making sure that either well, in my opinion, that they own or have owned the type of investment properties that you're interested in and have had experience in both buying and or selling those properties, so that you've got somebody that can talk intelligently, help you with spreadsheets, help you with calculations to understand your cap rates and your ROI and all those kinds of things.
Sean, you said
Okay.
something interesting to me that maybe the audience is not familiar with, but I think I heard you say um, you'd have been a lot happier if you'd have never sold. Did I hear that correctly? So I think what you were implying there is, and you can reference the blue book that Gary Keller wrote, The Millionaire Real Estate Investor, and it basically lays out very clearly the strategy of flipping a home, buying it, fixing it up, reselling it, versus the returns of buying a home, maybe doing some repairs, but renting it out and holding it as a long-term asset. And I would encourage everyone to go look at that book, because you'll find when you calculate returns, the returns are almost exponential on the long-term hold, which is where you were going with your statement. But it was very telling for me when the first time I read that, to see the numbers where where typically when you're investing for a flip, you know, a short-term investment, you're usually doing that for cash. It's cash on cash returns. Whereas the long-term investment not only provides you income from the rental, but you get that appreciation. And we talked about that earlier, Alan. You know, the importance of appreciation in an asset, not just the cash flow.
Right. And you know, you use the term cap rate so that everybody understands what that is. That is your annual, I mean, you could do it monthly too, but it's your annual return on investment. And that's going to depend on your revenue versus your expenses. And those expenses would be whether you paid with cash or with a mortgage. So obviously, if you paid with cash, you're going to get a greater return on investment than if you, on an annualized basis, than if you pay with a mortgage, because you have to pay off the mortgage. And that's included in your expenses. So when you're looking at investments, and especially for first timers, it's really important to be well informed and not just like, oh, I want to invest some money, you know, let's go look for a townhouse or something, you know, and working with somebody that has no experience, no knowledge. It's really important to understand, again, we've all talked about your goals, and it's also important to understand there are two ways to look at it. One is, what is your return on investment? And let's forget flips for now. Let's talk about holding property. What is your annual rate of return, your return on investment, or what we call the cap rate? And what is the appreciation potential? So are you the type of investor who is concerned with maybe 2 or 3 years or so, and you're not as concerned about the appreciation of the property, but you just want to get some income? That's okay. Or maybe you're someone who cares less about having a high rate of ROI, a return on investment on an annual basis, but there's a property that you find that's got great appreciation potential. You know, sometimes they work together and sometimes they don't. And these are questions you need to ask, because if you don't ask, you could be buying an investment that not going to work out too well for you.
Yeah, it's an interesting one, because I would, the only place where I might disagree is that your rate of return oftentimes is going to be higher if you don't pay cash. It's easier to get a cash flow out of a property oftentimes if you can pay cash from it.
Right.
However, the smaller the amount of money that you put into the property, the higher the rate of return, depending on how that structures. It's interesting how that there's a break point between I put a really small amount down and now I have this really large mortgage, versus most of my investors don't like to put all the cash in and hope for the return. They typically are going to leverage at some level to be able to kind of balance that outcome, like you were talking about, because one property is good for one and another property may be good for the other, and trying to figure out how to blend what you were saying, Alan, with appreciation versus you know, immediate return on investment, that kind of thing. It is, it's one of my favorite parts of real estate. It's actually why I got involved in real estate, was because I loved the numbers and trying to calculate. I actually have a video on my YouTube channel talking about the 4 quadrants and how, as a real estate investor, you get the return based on, let's say you bought something that cost $100,000, but you only used $10,000 to get it bought, and you're making, you know, $1,000, or excuse me, $100 or $200 a month in actual cash flow. But then you're also, somebody else is making your payment, so you're gaining appreciation. In addition to that, you're getting tax advantages on the property. So you have a third benefit there. And I'm trying to think what the fourth one is. All of a sudden my brain went blank. What am I missing now? And there's my cash on cash return, my appreciation, my tax benefits, and shoot, one other thing. Anyway, typically
Debt
with a
services,
with a
debt
good
services,
investment,
mortgage. Is
with a
that what you?
good, yeah, you got somebody else paying down your mortgage. So you have appreciation and you have somebody else paying down your mortgage. Thank you. And so all of those added together can easily, especially in the smaller price points, can easily be 100% rate of return on your actual investment, the amount of money you took out of your pocket to create this scenario. And I know I just sold one of my rentals this last month, and we saw that right over the last couple of years where we bought during COVID, still had appreciation, still had tax advantaged income. Somebody else was paying the mortgage, blah, 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 all those layers and layers of benefits. And once you understand that, it's where I was going with that trip where you were asking about, holding on to things that I shouldn't have sold them. All of those benefits over a decade of time are dramatic. So, and by the way, we just got our 15-minute notification. So, but yeah, I don't know. This is an area I love to talk about. I'm part of several investor groups here locally, just where we sit around and talk about it on a monthly basis and talk about opportunities in the market and different properties that might be worthwhile. So,
Yeah, and one other thing that I want to bring up, that as opposed to residential real estate where, everybody talks location, location, location. Not that location isn't somewhat important in investing, but if you have a good property that brings good cash flow, and it's not necessarily in the best neighborhood or one that you would choose to live in, that's okay. Because if you get, let's say you look at two properties and one's in like this really nice neighborhood and it brings you a 5% rate of return versus one that's in not as nice a neighborhood, but it brings you an 8% rate of return. Remember, it's all about numbers in investing. Which would you rather have? I know that I would rather have the one that brings me the 8%.
yeah, you're absolutely correct. It is. And we were talking about before we jumped on the call this morning that investment real estate is less of an emotional transaction. It really is spreadsheets, numbers, risk mitigation. What kind of a property do I want to have? What kind of return am I going to get? And in my case nowadays, how simple will it be to have this investment? I'm looking for mailbox money. I'm not personally looking for, I don't want to be a personal landlord. If I'm going to own something, somebody else is going to manage it and it will spit out cash. My folks, on the other hand, are directly at 80, are directly involved in their property. And they show up and do repairs still, and they know their renters, and that's their approach. And there's nothing wrong with either one of those. It just, you need to know what it is that you're looking for. It's why commercial real estate oftentimes is so attractive and it's such an interesting environment. Is most of the time in the commercial world, investors are just buying cash flow. I've got this much money. I want this much out of it.
I'm going to make one last point before we wrap up, because this is a lot of stuff to absorb, and I think it requires more, more conversation individually with any one of us, depending on where you are, or you could just reach out to us. It's also important when you're doing research or you're working with someone that's doing research to understand the local market, the trends, to know what's happening with the future of that area, because it may not be the greatest area right now, but if your realtor is looking into the plans in the city, let's say, for what is coming up over the next year or 2 or 3 years or so, the urban planning and what projects are in the works that are going to raise the property values, that's a place worth looking at, because growth around you is going to help your bottom line. So I think we've pretty much covered enough for this, don't you guys think?
Absolutely.
Want to wrap it up, Trip? You're the wrap-up man today?
Sure. I think that, and I'll be kind of succinct. I think, the whole investment world, um, if you're new to it, there's some resources out there that can help you. Bigger Pockets is one of the resources. There are a lot of books and a lot of online opportunities. But when you're choosing an agent, it's not only important for you to understand kind of what your goals are, it's important to understand, is the agent a fit for you? Do they have the knowledge base? Do they understand the intricacies of the math equation? Are they comfortable with numbers? Are they able to assess future sort of development that could affect your portfolio? Are you in it for short term or long term? I think all of these things can help you if you know how to ask the questions to your preferred realtor. And I think anyone here would welcome the opportunity, if you had more questions, to speak with you more thoroughly about that. But thank you for listening in with us today, and we'll see you the next go around.